Hello, my name is Riley Gross, and today I will be teaching you about financial statements. Additionally, I will also be utilizing AI to help teach this. So for my prompt that I put into Gemini, I said, create a scenario that shows how a few transactions flow through the balance sheet, income statement, and cash flow statement. And the three examples I wanted to use were raising capital, buying equipment, and making a sale to a customer specifically. Additionally, to help give me the prompt and results that I wanted, I said, A, break down these changes to the financial statements to help see exactly how everything is changing these financial statements in either a positive or a negative way. Another thing, write a Python script that models the transactions to kind of, once we go through and get an output for it, I will run all the code and we'll see how these affect the books of this specific company that we will get to once we go to Collab. And lastly, I wanted to use the KISS principle, keep it simple and stupid for ease of reading through it and kind of understanding this at a baseline level. Now, going to Collab, we have our example company, Simple Startup Incorporated. So before I go into these transactions for this example, I will first explain the three financial statements that we are learning about today. One is the balance sheet. So this shows your assets and liabilities and equity, which assets equal liabilities and equity on the balance sheet. And it's called a balance sheet because all these need to balance out. Additionally, we have the income statement, and this shows if a company is profitable. And lastly, cash flow statement, which is how a cash moves throughout the company, either inflows or outflows. So moving to the first day of this company, there's actually nothing on the balance sheet. We're acting as if this is a brand new company and they have done nothing so far. So $0 in everything, as you can see here. Now, moving to the first transaction here, we have raising capital, as I mentioned in my prompt. So in this scenario, this company, Simple Startup Incorporated, raised $10,000 in cash. So the way that this is going to affect the balance sheet, since cash is an asset, the assets are going to go up by $10,000. Now, income statement is not going to change, even though we did get cash. This is from investing activities, so it's not actually revenue that the company is going to report. And lastly, the cash flow statement is going to go up, or it's going to be an inflow in cash because $10,000 of cash just came into our company. Now, moving to the second transaction, buying equipment, we bought or used cash to buy $3,000 worth of equipment. So for the balance sheet, our assets are actually going to go down for a second, but it's actually going to be canceled out because the equipment is worth $3,000. So we had a negative $3,000 when we sent it to the people for the equipment, but they gave us equipment back. So balance sheet, nothing changes. Our assets are the exact same. Now, for the income statement, there is also no change. Now, eventually, we would have depreciation to account for, and that would be on the income statement. But since we just bought this equipment, there is nothing on the income statement so far. And lastly, for the cash flow statement, we would actually be sending that money out for the equipment, and we wouldn't account for the equipment on that because there was nothing related to cash on like an asset such as equipment. So $3,000 out, and it would be a cash outflow on the cash flow statement. Now lastly, for our third transaction, making a sale to a customer. So we bill a client, and on here it says on credit. So on the income statement, our revenue and net income would increase because they sent us that money. Now it technically hasn't been delivered yet, but, for the income statement, it would increase because we have got that money. Technically, it hasn't came yet, but eventually the transaction will go through and we will actually have $2,000 of profit on there. The balance sheet would increase by $2,000 again because our assets just went up. And lastly, we have the cash flow statement. So there is no change because it's on credit. Like I mentioned earlier, we haven't actually received the cash yet. So there's no cash to flow through the company. Eventually it will be there, but on the date of the transaction, there is nothing to account for in that scenario. Now, a few things just to think about. So money from investors, like I mentioned earlier, when I was talking about the income statement and why it didn't impact it, is because that's considered equity, and the only way to actually get revenue is from sales. So that's why it wouldn't be on the income statement. Next, I talked about on credit on transaction 3. So a company can actually be looking really good on paper, but they can actually not have much cash or any cash at all because all their transactions are on credit. So that's why it's important for a company to maintain good cash flow, because if you only have things on credit, you're not going to have anything flowing through your company, and it would be harder to buy equipment, for example. And just to go through the 3 financial statements again in really simple terms, the balance sheet is what you own and what you owe at a single period in time. The income statement is basically your performance over time, so accounting for revenue minus expenses. And lastly, the cash flow statement is exactly how cash flows through the company. So the next thing I will do is run my code and kind of explain the outputs here, which I talked about. All right. So for this first one, it appears for the transaction 1, which was raising capital from investors, we see that our cash went up $10,000. Our accounts receivable went up 0 because it was an financing activity. Sorry. Liabilities, there's nothing there. We didn't pay anything. Our capital share went up $10,000, and looking down here, our total assets $10,000, and then total liabilities plus equity is also $10,000, which is important for the balance sheet because we need these to balance out. And then, like I mentioned, income statement, there's nothing going through there because that raising capital was not actually revenue. And lastly, we have cash flow statement. Like I said, financing activity, so $10,000 would be flowing through an inflow. Our second transaction, we bought equipment for $3,000, so cash was reduced by $7,000, but equipment went up by $3,000, so it just balances out. And as you can see here, it is balanced. Income statement, again, there was nothing there. And then cash flow, like I mentioned, it is a decrease in cash for our investing in the equipment. And transaction 3, we have we made a sale to a customer, so we will be receiving $2,000 from them, but the cash hasn't actually quite hit yet. But as you can see, the assets and liabilities plus equity, they are equal to each other again, which the balance sheet should always balance out. The income statement, we actually made revenue because this was a sale. So when you sell something to a customer, it is considered revenue. And we didn't have an example of expenses, but if we would have bought something such as maybe materials or something, that could have affected our income statement and expenses, as well as depreciation costs for the equipment that we bought in transaction 2. And then for our cash flow statement, there would actually be nothing on that for right now, but because there is no cash actually flowing because it was on credit. Thank you for listening today.